right, well, Chris, welcome and thanks for joining us for what hopefully will be a nice, lively discussion about the state of startups and funding and other sort of industry issues right now.
Indeed, great to be here.
So let's just start, as I say, with startup funding. I think around $1 billion in the first quarter of 2025, lower in the second quarter. Do you kind of put all of that down to sort of macro factors, or do you think a portion of it is also kind of how uncertain we are kind of with the technology play right now?
I mean, it's a great question. I actually think it's a confluence of a number of factors. I think there certainly are, macroeconomic factors that still have investors trying to sit on dry powder, uncertain about future financings. I mean, part of our job is to make sure that we manage the entire financing lifestyle or life cycle of a
Yeah.
company. And so when there's uncertainty about subsequent rounds of financing, we all sit on a little bit more dry powder, try to stay a little bit more conservative. But I also think that we're seeing a time where it just takes less money to build companies. So while the overall numbers will come down, I still think that the pace of experimentation is very, very high. I mean, there's more activity happening, more entrepreneurial activity, more creative destruction, more new ways of thinking about the way value chains function than I've seen in the last 20 years.
Yeah.
And I think it's quite dynamic. And the numbers may not tell the full story, but it's very difficult to raise money. Right? It's always been hard to raise money, but particularly right now, it's difficult because there's so much uncertainty.
Yeah, I mean, we definitely see it sort of pre-seed and seed coming in, but we see very few kind of the later stage rounds. And there were one or two spotlights. I think Canary Technologies got around, Hollydew got around, but there's very little else out there. And I mean, what's the sort of, what's the knock on of this kind of going forward? Is it consolidation? Do some of these startups get acquired? What are you telling your portfolio?
Well, ever since rates began to rise, the mantra has been capital efficiency,
Yeah.
protect your balance sheet, push off financing as long as you can, focus on unit economics, all of these sort of basic fundamentals that sort of give give companies more longevity and a little bit more control about when they raise capital. But the reality is most of the later stage growth money is looking for the very best deals. And so you see some of the best companies raising large rounds at very high valuations, and everybody wants to pile into those rounds.
Mhm.
But there's not a lot happening below that sort of tier of quality. And some of it, I think, is that you have to think about or institutional capital in private equity as a bit of a value chain itself. And when the recycling of the capital, meaning, IPOs, M&A activity, the kinds of things that allow funds to return capital to their limited partners so that they re-up for the next fund, when that whole sort of value chain or supply chain of capital gets plugged up, things slow down a great
Yeah.
deal. And
Yeah.
so, I mean, I think that is the bigger challenge now, is that when companies need growth capital, it's not there for further experimentation. It's
Mhm.
there for scaling up what's already working. And
Mhm.
so any company that's still sort of trying to find that hot wire is still living in this zone of, somewhere between a seed and a post Series A, and they're figuring out how to bridge. And,
Yeah.
a lot of that doesn't get announced when
Yeah, for sure.
internal investors are just, bridging companies forward, or people are, doing whatever they can to preserve their cash. And that's the cycle that we've been in.
Mhm. You talk about those very high valuations where everybody wants to pile in and have a piece of the action. Does that mean, well, at some point there'll be a sort of correction? I mean, in the past we've had, companies who've had those high valuations and then they've wanted to perhaps exit or merge or consolidate in some way, shape or form. and haven't because of those high valuations, because it's they just haven't been realistic. Are we sort of, still in that? Are we heading for that again? Or how is that going to shape out?
It depends on if you're talking about, I think, travel specific companies, or if you're talking about generally what's happening in the broader landscape. Like some of
Mm.
these, giant AI platforms and the eye-popping valuations
Yeah.
they're getting, they may be set up for a very long-term cycle of remaining private. And interestingly enough, there's so much appetite for secondary. I mean, you're seeing it at OpenAI. They're making billions and billions of dollars of secondary available to
Mm.
early investors and to employees. And that creates almost this sort of synthetic kind of liquidity where they may never need to go public.
Yeah.
And so we'll never know what their real valuation is. It sort of is as it is. Now, in travel, at least the companies that are in my portfolio, the ones that have gotten very high valuations like Muse and Canary, those are backed by fundamentals. Those are backed by real revenue, real growth, high gross margin, competitive advantage, and an industry where, adoption is happening and, the total addressable market is quite large. So it
Yeah.
is, I think that those companies have all of the muscle they need to grow into their valuations.
Do you think there's ever a sort of vanity among founders that they want to IPO, that it's a dream of theirs?
For some, I think that the reality is though, as you get closer to that, running a public company is a complex pain in the neck, and there's a
Yeah.
lot of people who really don't want to do it when they get close to it. But there is something, of course, there is this sort of great badge. Especially for a founder, when you create something that ultimately you then take to the public markets and have a successful exit, that goes in your tombstone.
Yeah.
That's a very rare thing to accomplish. And so there are quite a few, I mean, I see that as a real goal, but it's certainly not the majority of the outcomes of venture-backed companies. The
Mm.
vast majority are M&A transactions.
Yeah. Yeah. So look, if the rounds kind of aren't there, or perhaps that some are there but being done behind the scenes, is there anything that would kind of save the year, do you think? Anything that could happen that would, bring back substantial funding?
Well, I mean, if we're looking for just the scale of dollars deployed, I don't think so. I
Mm.
don't think we're going to see monster rounds in our category. Now, there are large rounds happening for companies that we don't consider travel companies, but who are operating within the travel sector. Things happening in the payment space,
Yeah.
even in the crypto space, in stablecoin and other, sort of rails for payments and whatnot. And those companies, many of those companies, look at Built Rewards. You wouldn't think of Built as a travel company. We probably don't count the funding of Built as part of our landscape, but they are very much a
Yeah.
travel company in many, many ways.
Yeah, I mean the fact that I think they're one of the guys that heads up their partnerships, and he's ex IHG. So
Yeah.
and the kind of partnerships that they're doing, the Ubers and the big hotel groups, then for sure they're a travel company,
Yeah. I mean,
or tipping into it.
it's so interesting too because you look at Built, you look at Capital One, you look at Chase and American Express. We don't think of any of those as travel companies, but
Mm.
the reality is they are becoming huge, significant players in travel.
Yeah,
And
yeah,
so yeah, no, but to your point, I don't think that we're going to see very large pre-IPO equity rounds in private travel companies yet this year, because I think what we'll first have to see is an IPO pipeline that opens and is sustained, and then companies like, Muse, Canary, Lighthouse, and others that have the scale that start moving towards that that IPO window.
hmm,
And then typically that's where you may see a very large pre-IPO round, but you'll need to see a bunch of those to catch up to the numbers that we're looking for. What I think is more interesting, at least for me as a, more of an early stage investor, is, the amount of experimentation, trial, and testing that's going on by the big incumbents. How are the major travel companies, intermediaries, and others thinking about technology,
Yeah.
and how is the consumer landscape shifting? How are things changing
Mm.
in the whole marketing, merchandising, and selling of travel generally? Because as
Hmm.
those areas become more and more dynamic, you just know. I mean, I have great faith that there will be many, many exciting experiments that turn into very large companies. I think we may be in that time now where some of the biggest and most valuable travel tech companies are just being incubated because the noise is coming out of the market. There's more pressure on entrepreneurs. The accidental tourists of entrepreneurship are gone because it's hard. And so, this is the time, just like post-dot-com crash, where some of the most valuable companies are created.
So let me ask you a follow up there. Do you think that the kind of balance between, the shift between traditional travel models, which is, I guess, the OTAs, your origin, your destination type companies, and emerging travel startups, is that going to, is there sort of room for a B2C player to come in, and what might that look like?
Yeah, so I think that there is. I don't think it will look like the old days of high concentration among, an oligopoly of muscled players that sort of beat out all other competition. I think it's going to be a much more dynamic and interesting landscape. I think that the overall, the top of the travel funnel, I believe, is fragmenting and expanding in many ways. More and more players want to be deeply involved in the retailing of travel. In fact, I have a call later today with the team running travel at Walmart. That's really interesting.
Yeah,
What are they up to? What are they
yeah,
thinking about?
yeah.
So, and then you've got, in the world of travel discovery and search, that's shifting as generative AI becomes a really interesting and convenient and contextual way to think about where do I want to go, what do I want to do, and so and all of that is sort of interfacing at the same time with this constant, we've seen it now for some time, growth of social as a channel of inspiration and planning. Now, none of that yet has sort of converted into real booking, which we always think of as where all the economics lie.
Mm,
But the shift in the way consumers are engaging with travel and the way companies across the world are thinking about the merchandising and retailing of travel and AI is all just absolutely shattering in many ways the infrastructure that we've been building for the last 30 years. And so now it's the Pixes, the picks and the shovels and the axes and the Levi jeans of what's happening in the B2C world that's so exciting and interesting because data readiness now is the order of the day. You can't play in this new world if you don't have data readiness. So to me, that's where I think you're going to see an enormous amount of innovation, which is then going to unlock a whole new wave of B2C activity in travel, something that we haven't seen in a long time.
So then how challenging is it for you as an investor to kind of to make your bets, to invest right now? Because there's so much going on.
So we have adopted a strategy that we call construct and convict. So we will find a number of these early stage experiments and we will make smaller investments in those companies to get a seat at the table.
Yeah.
We then leverage our networks and our know-how, excuse me, in travel to add value, make introductions, truly support these companies. And typically, then what happens is a subset of those companies begin to take off. And then that's when we come in with what we call our conviction checks, which are much, much larger.
Yeah.
And that sort of model works very well in developing portfolios. And I think principally it's because you just don't know. I mean, luck and timing have always been two of the most important components of entrepreneurial greatness, right?
Mm.
And anybody who thinks that they can predict luck and timing is wrong. So I think you have to have a portfolio approach. You have to be around the hoop, and then you have to prove to investors that you matter and that you bring real value so that when those companies take off and everybody wants to increase their pro rata, um, they come to us because we've proven that we add value. So that's sort of the way we navigate the space.
So has your sort of ratio of investment to kind of success changed because of the state of flux? So before you might have said, well, invest in five and maybe two, three will pay off. Obviously, you'd hope that they'd all pay off, but in reality,
Yeah.
now has it become, well, we'll invest in, I don't know, you invest in a lot more smaller checks, but we know that a lot, that fewer will pay off. Do you have to adjust your sort of ratio that way?
Indeed. And in fact, I think as we're about to start investing out of our fifth fund, we expect to have between 40 and 50 portfolio companies in this fund.
Right.
And again, that's, half of the capital will be these experimentation construction checks, and half of the capital will then be in a very concentrated subset of those companies, and those will be our conviction checks. And I think the good news is it's a really interesting way to make sure that we're around the hoop with all of the best experiments. It's also our way of bringing great information and opportunity to our strategic LPs because, as you know, many of the big world's largest hotel companies and other travel companies are limited partners in our funds,
Yeah.
and they're in there for a reason, and it's not to generate returns, it's to, harvest information and have a
Yeah.
partner that's out on the edge of what's happening in the digital world, which is
Yeah.
what we do. So it enables us to bring a much richer sort of array of companies and information and hypotheses to the table, if you will. So yes, we will be building larger portfolios. We'll continue to be global very much. And we think that puts us in a great position to then find the muses and the canaries of the world that take off.
So, given the kind of the funding environment, what are the other routes to market for some of these companies? Obviously, when we cast our minds back to 2021, it was SPACs. Do you believe we're going to see a sort of resurgence of that as a vehicle?
We already are, and I think it's a function of a number of things this time. I mean, back in the last SPAC cycle that we lived through in 2020, that was a real bubble. I mean, that was an explosive bubble. There were way too many SPACs that went into the market very fast, and what happened was it drew a bunch of what should have been private growth stage opportunities to the public markets, and they just
Yeah.
weren't ready.
Yeah.
And the public markets are unforgiving.
Yeah.
Every 90 days, you have to deliver the goods. And that's hard to do.
Mm.
So that created, I think, a huge reset in that SPAC vehicle marketplace. We now have a macro environment that's very different. We have, and again, this has been driven by rates that went up, and when inflation showed up and rates increased, that changed the dynamics of capital generally. I mean, it really changed everything. So we have a great deal of companies that have investors that are long in the tooth. There's been a dearth of IPOs and M&A exits, so there's a lot of money that's just tied up. Limited partners aren't seeing the return and recycling of their capital, so they're not re-upping in subsequent funds, which is existential for private equity and venture
Yes.
capital. And so all of that is creating, I think, a little bit more interest in alternatives for companies. SPACs also, because of the black eye that the product got post this last bubble, now is a much more disciplined, smaller group of sponsors. I think you see far fewer vehicles out there. They're mostly repeat issuers. And in the end of the day, a SPAC is really more of a capital markets vehicle than it is a financing vehicle. And when
Mm-hmm.
seen that way,
Mm-hmm.
it's a disciplined, alternative, a door number two, if you will, for any company that for whatever reason wants to get to the public markets. And there are many compelling reasons to want to be public, especially if you have inorganic strategies. You want to buy companies, you want to build up your business that way. Being public can be an excellent way to do that. Lowers cost of capital, gives you a new currency to play with when you're thinking about M&A. So there are a number of companies that have strategic interest in being public, and the traditional IPO path is absolutely not available to them. It's just structurally not available. There's too much pent-up quality that's waiting to go that, if they wanted to get in line, it's uncertain. It's a 2-3 year wait, and that's just not going to work. So SPACs are an interesting alternative. They're not inexpensive, they're dilutive, but they're certain. And so we are seeing an insurgence. In fact, we're out there with a SPAC vehicle now, and there are a number of very interesting, good companies that it's a fit for. It's definitely not a fit for a lot of companies that should just be raising growth equity, and those companies are not coming to the SPAC space and looking for an on ramp to public, because I think everybody knows that that's not going to work out so well.
So you did go to a special purpose acquisition company before with Inspirato. Interesting
Yes.
journey there. It sounds very much as if you would go again. What would be the profile of a travel company that would IPO via SPAC right now?
So it has to be a company that is profitable. The public markets are not interested in taking on, massive losses and uncertainty in terms of cash flow. Ultimately, it really does come back to the net present value of all future cash flows as a way to value companies. It's hard to do when you have companies with losses, especially when those companies, the answer to their losses are the expansion of products and services that are relatively new. So, in our view, the right kinds of companies that are public ready are the kinds of companies that, are somewhat boring. 20% growth, profitable, understandable products that where you can really see the sort of slow, steady march and growth and expansion
Mm-hmm.
of margin. Those are and the public markets are hungry for that kind of product. Over the last, 30 years, there's been a contraction of names, yet there's been so much money that's come to the public market. So the public markets need more opportunity, but they want understandable, reliable, consistent businesses. The Hail Marys are, they're out there, but those are high risk for SPACs. In our view, in my view, in particular, the right kind of company that comes to the table like I said, a profitable company that has an element of its growth strategy as being inorganic. There's some very good targets for them that they want to acquire. That's a great way after they get public via SPAC to engage in secondaries that help address float, bring in more institutional following, and so forth, and then they become over time a true healthy performing public company.
Yeah.
So it's a different profile than what we invest in as a venture business. So that's why it's a really a different division, almost completely different division of our practice. Because it is, like I said, it's more of a capital markets vehicle than it is an investing platform.
So I think it was you, well, I know it was you that said that companies were going to have their, I'll say backsides. I think you said a shorter word back in November 2021. And sure enough, we saw that, we saw that with some of those accommodation companies that span up really quickly. And, do you think there's any of that same danger there now?
You mean just companies expanding too fast and being overvalued and
Well, and just thinking that because one or two companies are going to use the blank check route, that they should too.
it's different now because it's interesting, the investors, investment bankers, all of the individuals that sort of live in that decision space were burned only
Mm.
4 years ago.
Mm,
And so they remember that. So they're far more sensitive. In fact, there are far fewer targets now for SPAC door number two process to get public than there were back when it was a big bubble. So I don't think so. I don't think we're going to see a rush to the vehicle, but smart companies are, there are some really good companies also that are seeing this as an alternative. In fact, recently, you've seen more and more companies that have been preparing for a true IPO
yeah,
begin SPAC processes at the same time so that they're
yeah.
running a parallel path. And they're like, look, one of these doors is going to open, but we're going to be public.
Okay, interesting. Because you do hear some companies that the rumblings about, IPO and then it goes quiet again, and you think, well, is that because of all the uncertainty, and will they just wait, or will they come, as you say, through another route? So that's
Yeah, it's a
interesting.
testament to what the whole traditional IPO process is broken. It just is a mess. It's uncertain. The rules are strange. You know, it's um, it's so unreliable that for many companies, especially companies that that aren't in that top tier. There's a bunch of great top tier companies that are gonna, they're gonna IPO the old fashioned way, and they're Goldman Sachs is at the table, Morgan Stanley, they're ready to go when the window opens, and they'll wait. But then there's a whole nother tier of businesses where if they truly want, and I would assume any company that's preparing to be public is doing it for a reason. And it's not just to create liquidity for their investors. There's other strategic reasons to be public. And
Okay.
so, the SPAC vehicle, I think is going to, I think the product is here to stay. I don't see it surging again, anything like what it did before. There are a lot of very professional investors that are bringing these to market and working with good companies.
Okay. A few quick questions just as we round up here. Has there been a business that you wish you'd invested in travel?
There are so many. I remember taking a very early call when when Get Your Guide was a seed concept, missed that one entirely. Of course, I started this business around the time that Airbnb did its, I mean, just before its Series A. Not that I knew anybody there and I would have been able to get my way in, but there are so many opportunities that I wish that I had been able to get into Lighthouse back when it was, OTA Insights. That's been just an absolute home run. Yeah,
Yeah.
that's part of the anti-portfolio, we call it in venture. You always have a list of the what could have been, but you never
When you
know.
made your first ever kind of investment, how confident were you that it would work out?
Oh, I love that question because that's the truth is whenever somebody asks me what's my favorite investment, my answer always is the one I've made most recently.
Yeah, yeah,
Right, because and that's look, I am a butterfly catcher. I am an absolute perpetual optimist, and every little new rainbow has a pot of gold at the end of it, in my view. So and I think you have to kind of be that way to be in this business, although that's a very dangerous thing to be if you're on your own. That's why partners are so important. And my partners, Mike Scott and Tyler Carrico, is such an important part of the way we invest. But it's when I made that first investment, I thought for sure it was going to be the home run of the century. Didn't
and
work
was
out
it?
that way. No.
Just looking at all the startups you've invested in over the years, do you have favorites, like, and why?
Mm. You know, I do. I mean, I have favorites that where it's just because of the way that it's all come together. I have to say Muse is one of my favorites. And one of the reasons why is that I just absolutely adore Richard. I think
Yeah.
he is such a great guy and so smart and creative. But it's also just such a classic founder story. Prague, little hotel, irritated with the way it was asking himself, why is it done this way? And then and at the same time, we had developed our hypothesis about the changing of the PMS landscape, why it was important, why we knew it had to begin outside of North America because of chain concentration. So, our thesis sort of met with Richard's magic and then just watching it develop over time. And also, one of the greatest stories is the Richard Matt relationship. I mean, here is
Yes.
Richard as a founder
Yeah.
of a great company, and from the very get-go, he says, "I know I'm not the CEO,"
Mm.
and he goes and he finds a great one, right?
Yeah.
So, and how many times have I seen founders kind of hang on to needing to be CEO, but they shouldn't be?
Yeah.
And so Richard finds Matt, and now you've got, I mean, that's just the perfect combination, and the two of them work together beautifully. So that has been a real pleasure to watch. And the investors that he's attracted, I learn from every day. They're brilliant. The people involved with Muse today, and I do believe that that will be an IPO, in 2027 most likely, and that'll be a very, very large one. It's a great company.
Yeah. Chris, what's the unfulfilled ambitions? Like, what haven't you done that you still want to do?
Me personally,
Yeah.
um, I've sort of now moved to that. I turned 61 this last summer. So, I'm starting to look down the road and thinking, yeah, what is the end game? And, for me, I've always been passionate about entrepreneurship, about the nature of risk, about building things. I mean, it's what I always will be passionate about. And so some of what I'm really excited about now is the way, Thayer is developing with Mike and Tyler now at the helm. They've got 30 years of career left. And it's really fun for me to be working with them and watching them sort of mature into that position of total ownership of the
Mhm.
platform. They are great investors and very disciplined. So it's super exciting for me to be working with them and the expansion of our team. So for me, it's just more coaching and teaching and engaging from that perspective. And I know that that's what I'll do for the rest of my life. I'll never retire. I will
No,
just sort of transition into this amorphous thing where I'm, probably angel investing and spending time with entrepreneurs. It's just spending time with young people building great things. It's
but you'll hand the
what
baby
can be more
over.
fun. Say again?
You'll hand the baby over.
Oh, absolutely.
Yeah.
I think that's so important. It's part of the process.
Yeah. Let people come up, grow up. Yeah.
Absolutely.
Yeah. Chris, great conversation. Thank you so much for joining us.
It was my pleasure. Thanks for having me.
All right, then. Thanks.